knowing what each pattern represents based upon the candlestick signals, we saw after the UK situation where the market sprung right back, didn't really do a major reversal signal except for the fact that we saw everything bounce off the 200-day moving average. Produced some good profitability until it hit the resistance level. Once it hit that level, two things could be happening. They failed at this resistance level one more time and they were taking it down, or they were doing a J-hook pattern, which we can see illustrated by the fact that they couldn't close below the T-line. Then we have the simple doji rule. It's going to move in the direction of how they open it after a doji. So that positive open told us they were going to move in a positive direction, telling us last Friday that they were breaking out through this resistance level. Another move to the upside is just the continuation of that J-hook pattern, which is wave 1, wave 2, and wave 3 being the same magnitude as wave 1, which logically says we're going through this level and probably going through this level. The same analysis can be used on the NASDAQ, where we had a downtrending resistance level. Then we had the doji sandwich, a very common signal / pattern in candlestick analysis. And notice what happened when it got up to the 50. Did some consolidation, and there was our bullish engulfing signal right off the T-line. Notice one factor: once they came up through the T-line, they couldn't close it back below the T-line. Then the doji sandwich, telling us they were breaking out through this level, also is a clear indication, or provides an indication, there's going to be more upside. That's the results of a doji sandwich. Using that same analysis is providing big profits for us in the chat room in SGY. See the little bobble type patterns, fry pan bottom, breakout through the 50. There's your J-hook. We just have one simple rule. Once you see a candlestick buy signal and a close above the T-line, you can stay long until you see a candlestick sell signal and a close below the T-line. With a caveat that the further away you start moving from the T-line, the higher the probability it's going to come back and test it. So if we see another strong day in SGY, which we've had some very good profits in it so far, we go to our 10-minute chart and start watching to see if they take it down below the T-line on the 10-minute chart, which is kind of our suspicion based upon the fact that it's moved this far away from the T-line. With expecting the market to continue higher because of the J-hook pattern, we can go to individual stocks. Form, F-O-R-M, has been one of our recommendations. There's our left-right combo. There's our gap up through this little downtrending resistance level. And there's the beginning of wave 3, which wave 1 being of this magnitude should be the same magnitude on wave 3. This area right here, we can see that it was more just consolidation because of the indecisive trading and then the new buy signal versus hard selling that would take us back down to the moving averages. Using the signals and patterns in combination with each other, the candlestick investor has a much greater feel for what's happening in a price trend. That'll be it. We'll see you in the chat rooms.